Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
So it's late January 2026. And I have to be honest, if you've looked at a trading screen this week, you might be wondering if your software is broken. I mean, we are seeing moves in the market that they shouldn't statistically happen. Records are being shattered.
It's been a truly historic week for volatility, that is for sure.
Historic is a polite way to put it. I mean,
Yeah.
gold hasn't just broken records. It has absolutely smashed through the $5,000 barrier. $5,000 an ounce.
Yeah.
I remember when people thought 2,000 was crazy.
It's a massive psychological watershed moment. A huge number.
And that's not even the weirdest part. We have the Japanese yen whipping around like a penny stock, and then over in Europe, it looks like the industrial heartland of Germany is hosting a massive everything-must-go sale.
Right.
It feels chaotic. It feels like the wheels are wobbling.
It does feel chaotic, but, there's actually a very strict logic to it. We're seeing two massive storylines converge. One is immediate, fast, volatile. That's the currency story.
Happening in New York and Tokyo.
Exactly. And the other is slow, structural, and, inevitable. That's the industrial story happening in Germany.
And our mission today is to connect those dots for you. We aren't just going to report the numbers, we want to explain the mechanics underneath them. We're going to break down this rare maneuver by the New York Fed called a rate check, which, I gotta say, sounds totally boring, but is actually terrifying for traders.
Oh, it is. It's a fascinating piece of financial theater.
And then we're going to explain why aging demographics are forcing the biggest sale of German assets since, reunification?
Pretty much. So we have New York currency desks on one side.
And Stuttgart factories on the other.
They seem like separate worlds, but they are both driven by the same thing, this desperate search for stability in a reordering global economy.
All right, let's dive into the immediate fire first. The rate check. I saw the headlines flash on January 26th. NY Fed conducts rate check. Now, to a normal person like me, or someone just checking their phone at lunch, this sounds like they're just, updating a spreadsheet.
Yeah, let me check the price of milk.
Exactly. But the market reacted like someone tossed a grenade into the room. What exactly is a rate check?
It is, it's essentially a weaponized phone call. To understand this, you have to understand how the New York Fed works. They're the trading arm for the U.S. central banking system.
Okay.
And usually they operate quietly in the background, but on January 26th, they picked up the phone.
Okay, so they literally picked up a phone.
Physically called the major currency dealers, the big banks, JP Morgan, Citi, Goldman Sachs. The Fed calls them up and asks a very simple question. What is your price on the U.S. dollar versus the Japanese yen?
Wait, hold on. They just called to ask for a price check. Can't they just see the price on the screen like everyone else? I can see it on my phone right now.
They absolutely can. And the dealers know that the Fed can see the price. And that is exactly why the phone call is so significant.
Okay.
It's psychological warfare.
How so?
Well, by formally asking for the price, the Fed is telling the dealers, we are looking at this specific rate, we are concerned about it, and we might be about to do something about it.
So it's not about the information.
It's about the presence.
So it's like, okay, let me try an analogy here. It's like when a teacher stops lecturing, stands right in front of your desk, and just stares at you while you're talking to your friend. They don't say, shut up. But the message is loud and clear.
That is a great comparison. Or think of it this way, since we're talking about markets moving too fast. Imagine you're driving down the highway doing 90 in a 65 zone. You are flying.
I plead the fifth, but go on.
You see a police car parked on the shoulder. He doesn't pull out. He doesn't turn on the siren. He just flicks his light bar on for 1 second, just a flash of blue and red.
Oh, yeah. I hit the brakes immediately. I don't even check my speedometer. I just slam the brakes.
Exactly. You hit the brakes because you know what comes next if you don't. That is what happened to the currency speculators. The rate check was that flash of the lights.
A warning shot.
It signals that actual intervention, meaning the Fed actually entering the market to buy or sell currency, is imminent. And according to reports from Reuters, this is the first time the NY Fed has done this in over a decade.
Wow. So the market knows this isn't routine. This is serious.
It is.
But why now? I mean, Japan has been unhappy about the weak yen for a long time. They've been complaining for months. Why did the U.S. suddenly get involved?
And that is the key differentiator here. If Japan tries to prop up the yen alone, the market often just bets against them. Traders think Japan runs out of ammo eventually. It's one country against the whole world.
Right.
But when the New York Fed makes the call, it implies coordinated intervention.
Meaning the U.S. is backing them up.
Exactly. It signals that the U.S. government, and by extension, the Trump administration, is on board with the move. It creates deterrence. It's like bringing your...
And looking at the data, it seems like it worked instantly.
Oh, it did. On the day of the check, the yen spiked 1.2% to hit 153.89. Now, for listeners who don't trade Forex, a 1.2% move in a major currency pair in a single day is an earthquake.
That's a huge move.
It's massive. And it wasn't just the yen. The dollar weakened against the euro and the pound, too. The entire market repriced the risk of holding U.S. dollars.
Because they're afraid the Trump administration wants a weaker dollar.
Correct. And markets hate uncertainty. We have this political backdrop where investors are already nervous. We have President Trump in office, and analysis shows a lot of anxiety about upcoming Fed meetings and, who he'll pick as the next Fed chair.
Right, the person in charge of the money printer.
And there's a fear in the market that the administration wants to push the dollar down to help U.S. exports. So when that phone rang, dealers didn't think, oh, the Fed is curious. They thought, the White House is making a move.
This leads us directly to the other headline that has everyone talking. Gold. $5,000. I feel like we have to pause and just look at that number. Is this spike just a reaction to the dollar weakening?
That's the basic mechanism, yeah. A cheaper dollar means gold costs more, but 5,000 is. It's parabolic. What we're seeing now is the formation of what analysts are calling a risk basket.
A risk basket. Okay, break that down.
Usually assets move somewhat independently. But right now we are seeing the yen, gold, and bonds all moving in lockstep. When the rate check happened, the dollar fell, the yen rose, and gold shot up.
So investors are just piling into all of them at once.
They're clustering into these assets because they are terrified of something specific. They're terrified of the unwind.
The unwind. You're talking about the carry trade here.
Yes, the yen carry trade.
Okay, I hear this term carry trade thrown around on financial news all the time.
Yeah.
Usually by guys in suits looking very worried. Can we explain this simply? Like, pretend I'm 5. What is the carry trade?
Sure. Let's make it very simple. Imagine you have a credit card that charges you 0% interest, totally free money.
I would love that credit card.
Everyone would. Now imagine you take that credit card, you take out $1 million in cash, and you go buy a stock that pays you a guaranteed 5% dividend every year.
So I'm borrowing money for free, investing it, and I'm keeping the 5% profit.
Exactly. You're making 5% for doing absolutely nothing but moving money around. That is the carry trade. Investors borrow in yen because Japanese interest rates have been near zero, and they buy U.S. dollars to invest in U.S. stocks and bonds.
The greatest free lunch in finance.
It is.
Okay, so where's the catch? There has to be a catch.
The catch is the currency. You borrowed in yen, you owe the bank yen. If the value of the yen stays low, you're fine. But if the yen suddenly shoots up in value...
Like it did this week because of the Fed's phone call.
The amount you owe gets bigger.
Oh, I see. So if I borrowed 1 million yen when it was cheap, and now the yen is expensive.
Your debt just exploded. If the yen rises 20%, your debt effectively just grew by 20%. That 5% profit you made is gone, and now you're losing huge amounts of money.
So what do?
You panic.
Yeah.
You have to pay back that loan immediately before it gets any worse, so you sell all your U.S. stocks and bonds to get the cash to pay back the yen.
And if every hedge fund in the world does that at the exact same time.
The U.S. stock market crashes.
Yeah.
The bond market tanks. Liquidity just evaporates. That is the unwind. And that is why the Fed is getting involved with these rate checks.
They're trying to stop the crash.
They're trying to manage the yen's rise so it happens slowly, not in a violent spike that blows up the entire global financial system. A controlled demolition, not an accidental collapse.
That makes so much sense. So for the listener, the takeaway is pretty stark. Don't just watch the S&P 500. Watch the USD JPY exchange rate. It's like the fuse that connects everything else.
It is currently the central nervous system of global finance. If that snaps, the shockwaves hit everything from your 401k to your mortgage rates.
Okay, that is the world of invisible money. Flashing lights, phone calls, algorithms. I want to pivot now to the real world. Hard assets, steel, factories, machinery. Let's go to Germany.
A fascinating and slightly melancholic shift is happening there.
The headline numbers we found are staggering. According to the analysis, deal volume in Germany companies being bought and sold is expected to hit 2,400 transactions in 2026. I mean, it looks like a fire sale of German industry. Is the German economy just collapsing?
It's not a collapse, no, but it is a massive structural transformation. I like to call it the grandpa is retiring sale.
Grandpa is retiring.
Yes, you have to look at the unique structure of the German economy. It's built on something they call the Mittelstand.
The Mittelstand.
Right. These are small to medium enterprises, but don't let the name fool you. These aren't your local bakery. These are world leaders in very specific niches, like making one specific screw for a surgical robot or a special coating for a wind turbine.
And they're mostly family-owned, right?
Correct. And that's the problem. The post-war generation that built these companies is, well, they're reaching the end of the line biologically. KfW, the German state bank, released some really startling data. They warn that by 2029, about 114,000 companies per year face closure risks simply because the owners are retiring.
114,000 a year. That's like a giant football stadium full of CEOs retiring every single year.
It is a demographic cliff. Another institute estimates 190,000 companies are up for succession between 2022 and 2026. So just imagine a neighborhood where every single homeowner turns 75 at the same time. Their kids all move to Berlin to work in software. They don't want the factory, so they all put the for sale sign up on the same day.
Supply and demand. If everyone sells at once, prices just plummet.
Exactly. It creates a buyer's market. It's not necessarily that the businesses are bad. Many are profitable, highly advanced. It's just that there is no one left to run them.
But it's not just the small family businesses, is it? We're seeing giants like Thyssenkrupp and Rheinmetall making big moves, too.
That is the second driver. Corporate slimming down. The era of the bloated conglomerate is over. German giants are realizing they can't be good at everything.
Thyssenkrupp is the classic example. I mean, I think Thyssenkrupp, I think German steel, elevators and steel.
And yet, they're trying to sell their steel division to an Indian buyer. They're also selling a big stake in a bearing subsidiary. They're shedding weight to survive. Then you look at Rheinmetall, famous for tanks and artillery.
Right, defense is huge right now.
It is. So Rheinmetall is selling its civilian power systems division. They are going all in on defense. The logic is ruthless, but necessary. If a division isn't core to the future, it gets sold to raise cash.
So we have this flood of assets hitting the market, old owners checking out, corporations selling off the spare parts. This sounds like a massive opportunity for someone.
Yeah.
Who is on the other side of this trade? Who's buying Germany?
This is where the opportunity lies for the savvy investor. Germany's domestic economy is sluggish. Forecasts are around 1% growth. Bankruptcies are high.
Which usually scares investors away. I mean, why would I invest in a country with 1% growth?
For the general public, yes, stay away. But for sophisticated money private equity, institutional investors, bad economic news creates what we call valuation gaps.
Valuation gaps.
It means the price of the asset is disconnected from its real value. Foreign investors look at Germany and they see world-class technology, robotics, chemical engineering, specialized machinery selling at a discount because the macro story is bad.
It's like buying a mansion in a neighborhood that has a bad reputation. The house is still a mansion.
Precisely. They are buying the IP, the patents, the machines, not the German GDP growth. Analysis suggests up to 75% of the buyers could be foreign. We're seeing private equity firms swarming the mid-market, wires from the US, the UK, France, even Eastern Europe. They are cherry-picking the best assets from the grandpa sale.
So if I'm listening to this, what do I do? Do I just go buy a German ETF?
I would be very careful with that. If you buy a broad index, you're buying the sluggish growth, the regulatory headaches, all of it. The smart money is taking an asset-by-asset approach.
Explain that.
You don't buy Germany. You look for the specific companies that are doing the buying, or you find the niche players that are being acquired. A steel plant might be a liability, but a high-tech specialized bearing factory that just got picked up by a global conglomerate, that could be a diamond.
It's a stock picker's market, not an indexer's market.
100%. But there is a risk we need to mention: protectionism. Governments are watching this fire sale, and they are getting nervous.
They don't want all their best tech sold to foreign powers.
Exactly, especially in defense or critical infrastructure. If a U.S. private equity firm tries to buy a German defense contractor, Berlin might just step in and say, "Nine." Deal failure is a real risk.
So zooming out, we have these two massive stories. On one side of the Atlantic, we have the Fed in Japan and this high-stakes poker game to manage currency values. That's intervention. And on the other side, in Europe, we have a historic changing of the guard in industry transition.
Intervention and transition, those are the two key words for 2026.
How do they connect? Does the currency stuff in New York actually affect the factory sale in Frankfurt? They feel like different worlds?
They connect directly through the flow of capital. Think about it. We talked about the dollar potentially weakening because of the Fed's intervention.
Right.
Now, look at it from the buyer's perspective. A lot of American private equity firms are buying these German companies. They are sitting on mountains of cash, mostly in US dollars.
Okay, so if the dollar drops, their buying power in Europe drops.
In theory. But remember, the rate check is trying to stop the dollar from getting too strong against the yen. If the euro stays weak because Germany is struggling and the dollar stays relatively strong, American buyers are in a prime position.
So the currency volatility actually dictates who can afford to buy the German mittelstand.
Exactly. If the Fed loses control and the dollar crashes, American buyers might pull back because German assets suddenly look expensive. If the dollar stays strong, they'll likely buy up half of German industry. The phone call the Fed made last week could decide who owns a factory in Bavaria next year.
It's all one big ecosystem. You pull a lever in New York, and a for sale sign goes up or down in Stuttgart.
That is the reality of the 2026 market. And the provocative thought I would leave you with is this. In the past, we worried about recessions, we worried about earnings reports, did Apple sell enough iPhones? But in 2026, the biggest risk to your portfolio might not be business performance at all.
What is it then?
It's policy risk. The risk that a central bank manually resets a price, or a government blocks a merger, or a currency trade unwinds overnight because of a phone call. We're moving from a free market to a managed market. And you have to ask yourself, is my portfolio built for a world where the referee decides the score, not the players?
That is a sobering thought. The rules are changing in real time while we're trying to play the game.
They always do, but the speed of the change right now is, well, it's unprecedented.
Well, on that note, we are going to wrap it up. We hope this cleared up the madness of the $5,000 gold spike and the great German clearance sale.
It was a pleasure to break it down.
Thank you so much for listening to this deep dive. Don't forget to subscribe and hit that like button. We'll see you in the next one.